So a super interesting double whammy for you here in today's special Life in the Day of COVID-19 episode here at the Real Estate Crowdfunding Show syndication in the digital age at gowercrowd.com with your host, yours truly, Adam Gower. The first thing you're going to learn about today is everything you ever wanted to know about the impact of COVID-19 on CMBS. What CMBS is, how it works, and what kind of opportunities might emerge during the current crisis. Plus, I'm also going to show you something really cool that we've discovered recently as far as SEO, search engine optimization, and how to put your website on steroids. So first, my conversation with attorney Pete Larsen of Leger, Ketchum and Cohoon, my guest today, covers the impact of coronavirus on CMBS, and that in itself is an important subject right now, as you know. But to elevate the value of the podcast you are about to hear, we did some intensive SEO research to discover what people are most interested in knowing about CMBS right now, right? What are they searching for online on Google? And from that research, we created an interview outline that you're going to hear in this podcast. And then importantly, we wrote an article based on the podcast that follows that outline explicitly. Now, when people research the subject, how is COVID-19 going to affect CMBS delinquency rates? Google will see the article on my website with that very title, and in time will serve it to people running the search increasingly higher up in the search results. Now, it takes time for the page to be indexed by Google and for Google to recognize it as an authoritative page on the web answering this question. So if it doesn't pop up immediately in your Google search, just go to gowercrowd.com and search for CMBS in the search tool there on the homepage to find the podcast and the article. And then when you see the article, see how we build it, including some short highlight videos with Pete answering the very questions most asked by investors and by real estate professionals about the impact of COVID on CMBS. We've found this technique to work extremely well for SEO. Okay, so that's all there at gowercrowd.com, where you can also get access to the whiteboard workshop, where I walk you through exactly how to build a world-class digital marketing system so you can raise capital for your deals online. All right, let's get on with it. How is COVID-19 going to affect CMBS delinquency rates? Let's find out right now with Pete Larsen, attorney at Leger, Ketchum and Cohoon. Pete, thank you so very much for being on my podcast at this incredible time. You and I definitely went through it together. In fact, as we were chatting, probably met during the last time in while we were wearing different clothes, different hats. That's the
thing. That's right.
Last time, we'll chat about that at the end. But today, what I would love to talk to you about is a kind of 101 chat about CMBS. So let's start off with a top level question. What are commercial-backed securities? Commercial mortgage-backed securities.
Right. Commercial mortgage-backed securities are also known as CMBS. They're basically, they originate as regular real estate loans that you and I both know all about. No different than if you were to go to your banker. They start out that way. But basically what somebody has done on Wall Street is decided that, hey, this would be a good vehicle for an investment. So in order to make it an investment, they put it in a trust. And that trust is basically a group of loans, mostly a group of loans. Sometimes it's one or two very big loans, but it's usually a group of loans that they pool together and then make it an investment vehicle that ownership of that is traded publicly. So, in the last downturn, CMBS is talked about as the cause of that last downturn. And the reason they talk about that is because of the residential mortgage-backed securities that took a big hit. And what was happening there is they were just throwing in all kinds of bad loans amongst the good loans, and then it kind of went sideways.
Okay, so let me ask some dumb questions if you don't
Sure,
mind.
absolutely.
So what we're doing is we these CMBS, these securities, are a package of potentially hundreds of loans.
Right.
And you can buy the security, and the security performs against the overall performance of the loans inside that portfolio. So do you buy them at par, right? So you buy at par and then they have a coupon, and then the par value can vary, which effectively changes the coupon. How do they work, actually? Tell me about that.
Yeah, I mean, the funny thing about them is they kind of work against the market, right? So it's no different than a stock trade. They're trading, if a lot of them are being traded, then the price goes up because there's presumably a reason for that traffic. So sometimes they go up and down, they fluctuate that way as far as the trade, right? But the performance of the loan is important in order for them to keep their status, their tax status, which is a REMIC. It's called a REMIC, a real estate mortgage investment conduit. So they have that, for the IRS status, it's a REMIC. And so one of the worst things that can happen in this vehicle is if loans start going default and they're not creating the income that was anticipated throughout the life of this CMBS vehicle. So if that happens, then the IRS could terminate it as a REMIC, and then the whole thing blows up, and they're not going to be able to sell. They'll have to fold up and start over. So that's what they're always worried about, whether or not it's performing as anticipated.
Right. So again, just drilling down on this in terms of how they work.
Okay.
So you can buy a CMBS, you can buy a security.
Right.
And if you buy it at par, you would buy it at 100, let's say.
Mm-hmm.
It has let's call it a 5% coupon. Is that right? That's basically how. So you buy it not like a bond, but you buy a security at a set price. And that security comes with, and this is all formed in a question, Pete. So
Right.
If I'm getting it wrong, let me know. But you're buying it at, let's say, at 5% at par. And then as the value of those securities goes up and down, the yield goes up and down accordingly. Is that basically how CMBS works?
That's the basics of it. Yeah. Yeah.
Okay. And so during the last downturn, what I understood happened was that they were tranched, weren't they? CMBS. They were the good one. They were like the ones that were subperforming and the ones that weren't, and then all the bad ones were kind of honed off into another one, and then those were tranched. So
Yeah.
even inside a bad group portfolio, there were AAA loans because relative to the others, they were much better, even though they'd been taken. Can you explain that a little bit?
Yeah. So the best analogy, I think, to explain that is a CMBS factory, or let's call it the investment bank, was a sausage factory. Okay. And if you know how a sausage is made, they put it through a grinder and they put it into these casings, right? And so each one of those casings was a CMBS loan or a CMBS vehicle. And so they kept cranking out these sausages. And in order to make that CMBS vehicle as enticing as possible, they would cut off the ends, right? Because nobody likes the ends. And typically the way it was supposed to do is the ends were supposed to be thrown away or given back to the originator of that loan so they can deal with the problem. But what they were really doing is they were cutting off the ends and throwing it into the next batch, and started cranking them out, cutting off the ends, throwing them back in, cutting off the ends, throwing them back in. And pretty soon they're cranking out sausages that are all bad ends. And so that was what happened. They they wanted to keep that machine rolling, so they just kept throwing the bad loans back into the next one, and pretty soon you're getting a sausage of all bad loans, and it's going to go bad.
Right, but they were also they were given credit ratings, weren't they, Pete? That was
Mm-hmm.
the problem, is that these things were still given very high credit ratings.
That's right. Yeah, because it was a constant roll, and so they were giving credit ratings based on the information that they were given. You know, that Fitch or whoever was rating that particular group would do it, and a lot of it had to do with reputation too. I mean, these guys had a reputation of cranking out good deals, so they were like, they just kept going. And so, I think the rating agencies caught on at some point and started, which is what caused the whole downturn, is that they started saying, wait a second, that one's not good. And they started rating them poorly, and then the trading went down, and then nobody was getting
institutions that owned them had to get rid of them, didn't they?
Yeah.
Now, if I wanted to buy CMBS, if I went into my brokerage account and I wanted to buy some CMBS for whatever reason, what would I actually be looking for? Am I looking for brand names, or am I looking for something that actually says?
Yeah, each CMBS has a designation for it. So it's usually the originating investment bank, and then they have a number attached to it, and it usually has a year of when it was generated. So yeah, I mean, you could go to your stockbroker and say, hey, I want to buy into some of these CMBS loans, and then they would go and do their, they would come up with whatever ones are the best. They're doing it a lot better these days. I mean, they learned a lot in the downturn, but they're not as popular as they used to be either.
So let's talk about it, but let's actually get into the DNA a little bit further, if you don't mind, Pete.
Sure.
So a CMBS. So now here we have a retail bank, a high street bank, that issues a commercial loan to a borrower,
Mm-hmm.
and an investment bank buys those loans from
Right.
the high street bank, right, Main Street Bank,
Mm-hmm.
and puts them into a portfolio of CMBS. Tell me something about servicing and special servicing, and just kind of, again, 101 level, how does that work on CMBS?
Yeah.
Once it goes to the investment bank and away from the Main Street Bank.
Right. So just to make the correlation between Main Street Bank and CMBS servicing, it's not very much different. They hire a company to service the loan, but the big difference is the authority that servicer has and the relationship they have with the ultimate lender. So since CMBS is owned by thousands of people on the public market, it's structured in a way that certain people have certain authorities. So usually the servicer who's servicing a loan that's paying their bill every month, they don't have a lot of authority to do anything other than collect money and take account for it, right? And do the accounting and collect financials every year and do the maintenance of the loan. If that borrower wants to get anything done with a loan, it has to usually be with a special servicer, and the special servicer is going to work on it. And this is usually the problem that borrowers have, because borrowers of a CMBS loan are usually fighting with the servicer and special servicer to get something done that will keep their loan alive and keep things going, but they have a hard time getting things done.
Right, and it actually starts with, so you go to a high street bank,
Mm-hmm.
and you get a loan from Wells Fargo or whoever
Right.
it is,
Mm-hmm.
for your multifamily apartment building, and then one day you get a letter that says your loan has been sold, right?
Yeah.
Nothing has changed, but now it's with such and such a bank.
Right.
And it's there that the problem occurs, right? Because before you had a loan officer, presumably at the bank, who you
Right.
could call, you might even meet them, right? And go
Right.
in. And then suddenly now, here it is in some new entity. So there's nobody actually really to talk to. You could call the bank, but there's nobody there.
There's nobody with authority to do anything. Usually, it's the problem.
Right. And the
So
distinction between the servicer and the special servicer. So the first
yeah,
point is the servicer just does the admin, basically.
yeah, servicer deals with loans that are not in default, that you know, that are good active loans that are paying every month. That's the servicer. That's who you send your payment to. That's who, you know, asks you to send you financials every year. That's who, you know, does that kind of stuff. And they usually do like property um, inspections every once in a while just to make sure everything's
But the
okay.
building's still there.
Yeah. Yeah, that is still, that is actually a property and it actually is,
Right.
yeah, hasn't burned up or blown up or whatever. Yeah. And
And
then
then
the
the special
special servicer
yeah,
comes into play when, if a loan is in default, or if that loan wants to be assumed, or different things that only the special servicer can do. So if you are with your servicer and you say, hey, I want to, I want to sell my property and they want to assume this loan, then it has to go to the special servicer and then they'll ask for all the due diligence on the deal and all that kind of stuff. And they'll do whatever they have to do according to that um, uh, agreement that they have with the CMBS.
with the servicer. Now,
Yeah,
the funny thing is, though, just to be clear, because then now we're moving on to what's happening here in the market as we get a little bit
yeah,
deeper. But from a borrower's perspective, the only way to get to a special servicer, let's say you're looking today at the likelihood, let's say, or the possibility of default. So you hit April, you were okay, but May is looking a bit worrying, and June, you've got
right,
no chance of making your payment.
right,
But you're still here today, not in default.
right,
There's nobody to talk to about that until you actually go into default. So tell
right.
me something about that catch-22 that we're finding borrowers in today.
Yeah, I mean, sometimes they have to just stop making their payment in order to get something done, which is not really good for the CMBS. It's not good for the borrower. It's not good for the property. So it's not really the bet, you know, usually borrowers know when there's a problem coming, they see the future that because these guys, you know, they've owned properties for years. So they know I need help now. And in the old days, they just call up their banker and say, hey, we're going to have a problem. You know, we need to talk about this. But now they're calling the servicer and the servicer's like, are you telling me you're going to go into default? No, that's not what I'm saying. Okay, so there's nothing we can do, you know, that kind of thing. And so you're kind of caught in this turmoil. So, you know, sometimes borrowers just allow it to go into default and, you know, put that money off to the side and just say, hey, we need to talk to the special servicer. So now I'm in default. So
So,
but it's kind of a dangerous game to play.
well, yeah,
And
but
it's also very confusing to borrowers. They're not used to that and they don't know how to operate it. So usually they need help is really what it comes down to.
all right. So now let's talk about the TREP CMBS delinquency rate. First of all, what is that? Right. And secondly, how is it looking going into 2020 and what's going on with it now?
Yeah, I mean, I think it's no different than what the banks are looking at right now. Everybody's kind of in a wait and see mode to see if the economy bounces back, and if it does, then we'll be okay. But I think there's certain asset classes that are probably hurting the most, and that would be, you know, hotels, multifamily. If people are out of work, depends on what class of apartment building you have. But yeah, I mean and commercial, you know, leasing, that area is probably going to hurt a little bit.
Let me just ask, what is the TREP CMBS? What is TREP actually?
Um, you know, I'm not real familiar with that.
What
Except that
is that?
it's probably. Let me just. I think I
Sure.
know what it is, but
Oh, good. I'm so glad that I'm not the only person that doesn't know what that is, but it is what
I
people.
think TREP is just a company that
The TREP
analyzes these
delinquency
things.
report. Here we go.
Yeah, I think TREP is
TREP.com.
just
Okay.
it's kind of like a Bloomberg type of company or whatever that are kind of monitoring these things, and they monitor CMBS.
And so going into 2020, presumably delinquency rates were what, at lows? I'm just guessing because the market was so
Yeah,
hot.
I don't know the exact number, but they were low. Yeah, I mean most loans were good and moving on. And if anything, the only thing that the special servicers were doing were assumptions where the borrower wanted to sell the property and the buyer wanted to assume the loan. So, that's probably what they were working with most. And
As
then,
much head scratching as they had to do, right? Now, so
yeah.
what's COVID going to do you think, to CMBS delinquency rates?
Well, I think the delinquency rates will go up. Definitely to the extent that they need to restructure the loan or to, get some type of forbearance for this period. So I think that there will be a lot. I mean, the special servicers are going to be busy, I think, in the coming months as COVID, works its way through. I listened to a thing by the Financial Times about the economy, and they were saying, that most people, like our president, would want the economy to bounce right back in a V formation and just go right back to where we were. But it's more likely, if realistically, to be more of a W type of return where it's going to bounce and it's going to come back down and bounce back up. And then we might start getting the trend up again. So it's not going to be as easy as the government would like us to think, but I think it'll be better than 2007 for sure. I hope, because that was awful.
Really? Well, yes.
Yeah.
So let's talk about that, but let's just pause to talk about that and just kind of finish up on this one main cause. I'm very interested to hear your thoughts about how the world looks today versus 07, right? You and I went kind of lived through that.
Yeah.
So what are the you were talking about the different sectors.
Yeah.
And just for clarification, in CMBS, every single sector has some form of CMBS, created for it. Is that right?
Yeah, and they're usually a mix. Like a CMBS vehicle may have a good mix of property, which is the smartest way to do it. So you have asset classes in all different areas. But there are some CMBSs that are specifically, commercial office space in New York City or whatever. So, yeah, I mean there are different types of loans, and but most CMBS are pretty diverse enough to kind of go across all different asset classes.
I see. Interesting. Unlike REITs, right?
Unlike a REIT.
Yeah, REITs are very hyper focused on specific asset classes, but CMBS are very broad.
It depends. It really does depend, but typically, done smartly, they would do it much more diverse, because that helps with the downturns of asset classes.
Okay, so how does that work then? Let's say you mentioned hotels, right? Hospitality is particularly badly hit. Yeah. So if you have a portfolio of, I don't know, how many loans typically? I mean, I remember when I was at Colony during the last downturn, we took on portfolios from the FDIC of 800 to 1,000 loans. They weren't CMBS, but they were kind of packaged in the same way. Is that? But they were smaller as well, $1 billion portfolios or so. So there was a broad range of sizes inside those. Is that typically what you see in a CMBS in a package?
Yeah, I mean, it could be anywhere from one loan all the way up to 100 or to 1,000. It just depends on the asset classes and how much money they planned on raising for that particular issuance. So it depends. It really does depend. But I would say probably an average is around 100. But it's, if they're high valued assets, it might be only 20 or 30.
Interesting. And then if some of them, let's say one has hotels in it, hospitality, and those are dragging down the entire portfolio.
Yeah.
How does that impact the REMIC consequences? If there are just a few, are they able to split those off in some way, or are they all married together? Is there any way to bifurcate the portfolio once it's been created?
No, it's together forever. They're a family forever. Unless, of course, loans get paid off and refinanced and all that kind of stuff. So little by little, that CMBS issuance dwindles down. But yeah, to answer your question, if you had a 20 loan portfolio in a CMBS issuance, and 10 of those were hotels, then that could really cause some problems. And what the what the special servicer is going to be worried about is whether or not that's going to terminate the REMIC status of the loan. And so that's what their duty is, to make sure that that doesn't happen. So they'll have to do whatever it takes to fix that, whether it's a forbearance or a modification or whatever, in order to keep that thing alive. And then that's what they have to analyze, the best thing. And then they have to get opinion of counsel to make sure it doesn't break the REMIC status. And it's a whole process.
And that REMIC status, those are specific financial criteria that talk about the period of time that a range of loans inside a portfolio are in default, and et cetera, right?
Yeah, it's basically an IRS vehicle. REMIC, it stands for Real Estate Mortgage Investment Conduit, and it's an IRS vehicle and status. So they have to have that status in order to be rated properly and traded on public, so if they lose that status, then they can't trade anymore, and then all those people have to, then you have to liquidate the whole thing, and it becomes a problem. So it's a tax status, I guess, is the best way to say it.
And who does that? Does the special serv, if it goes into REMIC default? So
yeah, so the special servicer is going to be involved in making sure that it maintains its REMIC status. And in order to do that, they have to, try to come up with different ways to fix that loan, whether it be to get a new borrower in, whether it be to refinance it out, whether it be whatever it is, they're going to be trying to do. I think for some borrowers who got into CMBS and didn't really understand what CMBS was all about, they may be looking at this economic stimulus package to maybe help them out of the CMBS loan. I mean, that could be a possible avenue for them, where they say, okay, this is still a good asset class, and we'll come back when the economy comes, and we'll just refinance with a traditional bank. We've got enough equity in it now, let's refinance. So that could be a way out for them, because it's hard. It's really hard to deal with. And it's not just because the special servicers are trying to be hard. It's because they have a duty to maintain that REMIC status. And so they only have certain things they can do. And then they have to get opinion of counsel, the tax counsel, they have to get opinion of the borrower's counsel, they have to get opinion of the servicer's counsel. And then it all, in order for them to maintain that REMIC status.
Okay, so two questions on that. First of all,
Yeah.
So the implication that you made there is that I could, if I wanted to borrow to finance a 100-unit apartment building, I could go to a CMBS issue and borrow directly from them to go straight into a portfolio of CMBS loans. Is that right?
No, I was talking the opposite way, getting out of the CMBS loan.
Right, got it, right. So there's no option for a borrower to go into a CMBS. It happens at the bank level. So you borrow from a bank.
It's only new issuance, right? So there are lenders still out there that are lending in CMBS, and what they're doing is they'll, going back to our original discussion about how these are generated. Typically, it's a specific lender that is lending specifically for CMBS, and they have a set of documents and set of criteria, a set of underwriting that they have to do in order to be able to sell that up the chain to the investment bank in order to securitize it. So the borrower knows up front that this is going to be going into a CMBS.
And the advantage to them is because the advantage of doing that is because rates are cheaper, or it's
the rates are sometimes better and sometimes less equity. That was the big, incentive for a lot of borrowers is it was 90% loan to value as opposed to 80 or 70, 75, on a multifamily.
I
So
see. And now, if one of these portfolios does fail, right? The special servicer is unable to preserve its REMIC status to keep it healthy.
mhm.
Then the special servicer must do what? They must sell the portfolio and liquidate.
I don't think that they would let it get to that status. I think they would be, I mean, they wouldn't want it to get to that status. They'd want to be doing whatever. I mean, the investors are going to be losing money no matter what, right? If all those loans go delinquent, just like in the last downturn, those investors are going to lose money, but they're trying to maintain the REMIC status and lose as least possible for the investors. So it's kind of a balance of what they're doing, but they're not going to let them lose the REMIC status. They're going to keep that. They're just going to try to mitigate the loss for the investor at that point.
So you buy at 100, right? I call my broker, my stockbroker, and he buys me a share in a CMBS portfolio, and I pay 100 for it, and everything starts to do what it's doing now. And my bank statement suddenly, or my statement suddenly says, okay, this thing is now worth 50 cents or 40 cents, etc. So that's how the special servicer preserves the REMIC. Well, is that how they preserve it? I mean, it's just the value of the portfolio goes down, right?
Yeah, I mean, it's just the value goes down. Yeah, the REMIC status has to do with certain criteria that the IRS requires for them to keep that status. But yeah, I mean, the value is going to go down. The rating from the rating agencies will go down. And then, then it's harder to sell that, right? Like if you bought at the top of the market and now you're sitting here looking at this possible downturn and you're trying to sell right now, would be a bad time to sell. Might be a good time to buy if you think it's going to pop back up, but a really bad time to sell. And so, that's where you'd be worried. Of course, we can get into all the option trading and all that kind of stuff that people do, right? We're not going to get into that. But because there are people probably still making money because it's going down, right? Because they bought an option.
So as we talk about this, I'm kind of transitioning into what happened last time. So as the special servicer now has some problem loans, right? They've got some loans inside this portfolio that they need to somehow resolve. Are they able to, one, give breaks to borrowers who maybe have either problems paying or maturing loans and no way of refinancing them, or can they sell those loans? Can they take them out and liquidate them at a loss to face value?
Yeah, I don't think you would see a CMBS loan being sold, which is unfortunate because I think that would be a much easier way for them to deal with it. But because they have to keep that thing intact, they're not going to be able to sell out individual loans unless they unraveled the whole thing and sold out the loans, which isn't going to happen. So, yeah, I mean, but there are things that they can do for borrowers. So they might give them a forbearance, or they might do a modification on the loan, especially given the history, right? If they know the entire history of the loan. So, if you've been paying all along and the economy was going up and we're just in this little blip of who knows what, then they might give them 90 days to see what happens, or they might, modify it after this is all over so they can, they recapture all of the default amounts and put it into a new modification going forward. So their payment might go up or whatever, or the interest rate would change, whatever. They could do some things. Yeah.
So and the special servicer has that power to renegotiate these.
Yeah, because their obligation is to make sure that the investment gives the best return. So that's what they're going to be looking to do.
So let's talk now about how the world is different today, Pete, from the last time. Last time in 2007, 2008, when our steel was forged. I like to think
Yeah.
of all this stuff. So how does it look different? What's changed? And again, just to contextualize it, you and I both know, but for the one guy who's listening who doesn't know my background, we were selling a lot of notes for banks. I think that's how you and I met, actually. I was selling non-performing notes for banks, and the bank itself had that authority to sell a loan if it wanted to at a loss. And a buyer could buy it and then basically stood in the shoes of the bank. With CMBS, tell me how the world looks a bit different from the way it did last time.
So I think, what we were doing, back in those days while the banks were being closed down and banks were worried about being closed down, a good option for them was to sell the loan, which made more sense than to foreclose and take on real estate. The problem, I think, back then, what created all of this was that, one, there were lenders lending money that had no business lending on certain properties they just didn't know about. So they were creating bad loans. I mean, most of the loans that we worked out from the FDIC were all that kind of fit in that area where that bank didn't know enough to be lending like that, and they didn't underwrite it correctly. And so, they were just giving money to anyone because they were hoping that they could sell it down the line. The community banks shouldn't be, generating and selling loans like a bigger bank should. I mean, that's one of the criticisms. So back then, there was a lot of loans being made that shouldn't have been made. And then somehow some of those ended up into CMBS issuances because of the sausage maker mentality. They were just throwing them back in. So, that's what was going on then. I think now both bank lenders and CMBS lenders were much more careful about what they were putting into the mix. So they were, the underwriting got a little more stringent. They were making sure that these were good borrowers, making sure they were well guaranteed, all that kind of stuff, which wasn't happening before. I mean, in the last, market upturn before 2007, it was just, if you put a mirror under your nose and you saw
Exactly, that's
you
right.
saw that they were alive, you'd give them a couple $1 million. That's not happening anymore. So hopefully, any downturn will be a lot more smooth. But just like any uptick in the market, there's going to be some carelessness, I think, and people forget so easy. It's like a woman having a baby. They forget what the pain was and they want to have another baby. It's not different. I mean, these lenders forget what that pain was like because they get so caught up in the euphoria of the lending craze.
I think that's a common fault for all. I think it's why we have cycles. It's very easy to forget the bad times, right? And just enjoy the good times. All right, so let me wrap up with one final question then.
Sure.
One final theme. So the last time, I sold, $1 billion of these notes one at a time. I don't know, you guys over there did vastly more than that. I remember you guys were in the deep end, even more than I was. But the people that we were trading with on the other side of those distressed loans made a lot of money. It was with big risk. There was a lot of work involved. You buy a loan, now you're the banker, so you got to deal with all the unraveling and everything that's associated with that. But if you knew what you were doing, it was a period of wealth transfer.
Yeah.
That what we're going to see today. Put another way, where is the opportunity for investing in real estate in this context today?
Yeah, I think absolutely we're going to see some discounted note sales happen. I don't know how many there's going to be. I was in a conversation with a group of guys from Citus, from my previous from the last time this happened, and they were all wondering whether we're going back to that again. I think it'll be a degree of that, but I don't think it'll be to the same degree. So there are bad borrowers out there still, and that probably were just riding the wave of the real estate and didn't really take care of their property. And now that their property is not generating income and they're not being able to make their payment, we're going to find a lot of properties with deferred maintenance and all that kind of stuff that they kind of put off to the side to kind of leech off the profits. So yeah, I think that's going to happen. That we're going to find out as some of these go into default that they're not going to be able to come back, and the property is in a state that they're not going to be able to convince the CMBS servicer, special servicer, that they can make it out of it. So yeah, I think we're gonna find some transfer of property here, and it'll be at a discount.
Yeah, that's interesting. So last time it was systemic. This time, really, it's more,
I think it'll be more spotted.
Yeah, and
Throughout
also
all asset classes, it'll just be those guys who just, maybe it's their first time around, or maybe they're not as experienced, or maybe they just wanted to make a quick buck and deferred a lot of maintenance. So
or whatever else, maybe just operated, just didn't really know what they were getting into. Right? I love seeing, in my business, I love seeing people bragging about their 10 years of experience in real estate.
Yeah, that's right.
Okay. Well,
I'm watching you.
That's right. Exactly.
Yeah, it's an interesting time because this will kind of shake out the property that probably needed to be shook out. It's kind of a good cleansing, I think.
Well, on that positive point, I would like to thank you, Pete Larsen of LKC Law. Now, I've written it down. Let me just, I'm going to say the full name. I need to pronounce it right. Ledger, is it? Ketchum and Cohoon?
Leger, Ketchum.
Leger.
Yeah, Leger is a Louisiana Cajun name.
Ah, okay. Leger, Ketchum and Cohoon.
Right.
Thank you so much, Pete Larsen, for your time with me today. Really informative.
Absolutely. Thank you.
That was Pete Larsen at Leger, Ketchum and Cohoon, talking about the impact of COVID-19 on CMBS. Be sure to check out the COVID-19 resource page at gowercrowd.com to access all the resources I've put together for you there to help you through these crazy times. There's a lot there, including some free training. There's some other podcasts, articles, discount off our flagship investor acquisition system, online master course, and a bunch more. That's all there for you right there at gowercrowd.com. All right. That's it. Thank you for listening. And thanks so much, Pete Larsen, attorney at Leger, Ketchum and Cohoon, for your time with me today. I really enjoyed talking to you. It's good to see you again. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.